Welcome back to the Money Loop, the channel where we break down money, markets, and investing concepts in the simplest way possible. Today, we're talking about one of the most famous rules in investing, diversification. You've probably heard phrases like, don't put all your eggs in one basket. But what does diversification actually mean? And more importantly, why does it actually work? Because diversification isn't just about owning a bunch of random investments, it's about reducing risk without completely sacrificing growth. So let's make diversification actually make sense. At its core, diversification is surprisingly simple. Instead of betting everything on one investment, you spread your money across multiple investments. Why? Because different assets behave differently at different times. Some investments go up while others go down. Some industries boom while others struggle. And by combining different types of assets together, you reduce the chances of your entire portfolio crashing all at once. Diversification is really about balance. You're trading a little bit of potential upside for a much smoother and safer ride overall. Imagine putting your entire life savings into just one company. Maybe it's a huge tech company that seems unstoppable. Everything looks great until something unexpected happens. A bad earnings report, new competition, a lawsuit, government regulation, a market crash, and suddenly this stock falls 50%. If all of your money is in that one investment, your entire portfolio gets destroyed alongside it. That's the danger of concentration. Even great companies can go through terrible periods, and nobody can predict the future perfectly. Now, imagine instead that you own hundreds of different investments. Some tech companies, some healthcare companies, some energy companies, maybe bonds, real estate, or maybe even international stocks. Now, if one company or one industry struggles, it hurts your portfolio much less. The winners help offset the losers. And that's the real power of diversification. It reduces what investors call unsystematic risk, the kind of risk tied to individual companies or industries. You can't eliminate all market risk, but diversification helps reduce the avoidable kind. Think of diversification like building a sports team. If your entire team depends on one superstar player, you're in trouble if that player gets injured. But if you have a balanced team with multiple strong players, the team can still perform well even when one player struggles. Investing works exactly the same way. No single investment controls your entire future. And psychologically, diversification also makes investing easier. Because when one investment falls sharply, you're less likely to panic if the rest of your portfolio remains stable. This is one of the reasons why index funds became so popular. Instead of trying to pick a few winning stocks, index funds instantly spread your money across hundreds or even thousands of companies. For example, Standard & Poor's 500 index gives you exposure to hundreds of major US businesses across many industries. So your success doesn't depend on one company being perfect, it depends on the overall economy growing over time. And historically, diversified investing has outperformed most active stock pickers over long periods. But diversification is not magic. If the entire market crashes, most diversified portfolios still fall too. Diversification reduces risk, but it does not eliminate risk. And there's also such a thing as over-diversification. Owning too many investments can sometimes limit your upside and make your portfolio unnecessarily complicated. So the goal isn't owning everything, it's owning a smart mix of different assets that behave differently from one another. So hopefully diversification feels a lot more intuitive now. It works because different investments react differently to different situations. And by combining them together, investors can reduce unnecessary risk while still participating in long-term growth. If you enjoyed this video, subscribe to the Money Loop for more simple explanations of investing and finance concepts. And I'll see you in the next one.